Welcome back. Well, the markets have moved into the green, so the little bit of a dip that you got, that's got bought into. But let's see how things go from here. It seems, by the sense of it, the markets want to move up, and the 100 DMA has now been crossed. But as promised, let's get straight to the next corporate, KPIT Technologies. They posted a very good set of numbers. The margins is well expanded, and the stock has been surging since yesterday. Well, Mr. Sachin Tikekar, the joint MD of the company, joins us on the show. Hi, Sachin. Good morning, and first of all, congratulations on a solid showing. The numbers look good, guidance as well looks good. Let's get a couple of details, though, out of the way. You're guiding for revenue guidance of close to around 27 to around 30%. Will it be evenly distributed, or is it likely to be back-ended? And the other point is margins. What a splendid improvement we have seen over the last few years. From the low teens, now it's moving to the high teens. What more levers do you have from here, and where do you see this headed?
No, excellent questions. Thanks for having me, and good morning to all of you. We are very happy with how the last year panned out, and we do appreciate your kind words about our performance. It's been consistent over the last 11 quarters, and not only the growth in top line, but also in the margins. As far as our guidance is concerned, let me answer your first question about how do we see the growth of 27 to 30% year on year. It's looking fairly even at this point in time. And I would say that if you look at the macroeconomic scenario, second half of the year is likely to be softer than the first half. If you look at the markets that are most relevant to us, which are Germany and France in Europe, and then, of course, the US and Japan. Right now, things are reasonably good. From the macroeconomic perspective, they are likely to be softer in the second half. Having said that, the vehicle sales are likely to be flattish and softer in the second half. However, our business doesn't depend on the number of vehicles being sold. It largely depends on the vehicle programs that we work on, which are usually for 3 to 5 years. Given that, we believe that the growth is going to be fairly even across the 4 quarters. So that's the question about the growth part. And the second part about the margins, I think the big shift happened a couple of years ago from, as you said, from early teens to mid-teens, and now we are getting into late teens. What we believe is, first of all, the growth is going to be fairly healthy. Secondly, the quality of work continues to go up, and we believe that will help us to increase our margins a little bit more. There is also some productivity gain, and we believe that we continue to get better pricing.
Sachin, what is the target? What is the target on margins? From low teens, it's high teens. Now you're given a guidance of 19 to 20%.
Absolutely.
Another couple of years,
Absolutely.
Can you go even higher? Can you even go higher than this 20%?
Absolutely, that's the goal. And this year will be between 19 and 20%. We believe that in the next year or two, we'll continue to have profitable growth. The point is to go beyond 20% next year and the year after.
Okay.
Having said that, yes, please go ahead.
Yeah, got that, Sachin. So you're looking at 20% plus margins, perhaps FY25 and beyond. So that's one point that we've noted. I just wanted to go back on the top line question for a bit. 27 to 30% is scorching growth. I mean, that's the guidance you've given out for FY24. But if I could sort of nitpick, it does point towards a slight slowdown compared to the year that just closed, where you grew almost 37%. This we're talking constant currency top line growth front. Now, I just want to understand, is that because this year was or rather FY23 was an outlier year? You had these mega deals with Honda, with Renault, and you're not expecting such huge deals next year? Or what's the reason why you don't think you can top the growth that you've done in FY23? And also give some color on these big accounts, the likes of Honda, which fetched you $250 million in Q4.
Absolutely. If you look at it, the second half of last year, we had inorganic growth from acquisition of Technica. That will not completely help us this year. So if you look at, if you compare, organic growth is likely to be similar as compared to the last year. So overall growth perspective, we believe that we're going to grow. We're going to be growing apple to apples, similar to the kind of growth that we had last year. So
that means
hope that
flat organic growth. So Sachin, just to clarify, you mean, let's leave aside the acquisition bit, organic growth, apple to apple comparison, you'll be flat in FY24.
Well, we had a solid growth last year. It will be similar to the growth, that we are likely to see in the new year as well. I don't want to say flat in the sense 36%. Let's say out of that, the growth was again, the organic growth was in the range of 27 to 30% last year, and this year we are also calling out 27 to 30%. So that's what I meant by flat. It's similar. Does that clarify?
Yeah, it does. I'm just wondering if the market's so excited about your huge wins. Names like Renault,
yes.
Honda. So if you could just give some more color, if we can expect more such deals in the pipelines in the near future.
The way it works is we continue to work with our T25 OEM clients, mostly in passenger cars and commercial vehicles, and some of them are happy to announce the kind of engagements that we have announced with Honda and Renault. However, not all of them are comfortable speaking of such engagements in future. What we are doing is the existing clients, as they are launching new programs, our business continues to grow with them. So you may or may not hear about such large engagements being announced going forward. However, we see growth in almost every account that we are working with year on year. Some of them may feel comfortable making a long-term commitment and announcing it, and some of them may not. However, the pipeline has been stronger than ever before, and we believe that we can build on that pipeline as we get into the year.
Sachin, hi, good morning. As a percentage of your target market, which is, and the target is basically the shift towards electric, autonomous, connected vehicles, right? That's where a lot of the capabilities that you offer come into play. What percentage of that target group are you already servicing? I mean, are you already at 70-80%?
We are servicing all of them. So if you look at the way we look at our businesses, one is feature development and integration of the vehicle. Second is, which is becoming more and more important, as you hear about software-defined vehicle, which is the whole architecture and middleware. And third is the cloud and connected. We had robust growth in all three last year, and we believe that the growth will continue. Obviously, the cloud and connected is a smaller base for us at this point in time. So in terms of percentage growth, you'll see a lot more growth coming from there. However, we see continued growth in both in feature development as well as the middleware and architecture. They are all interconnected. You start with middleware and architecture, and then you get into feature development. And once all of that is in place, you get more of connected and cloud-based. So, one sort of dovetails into the other one.
Okay. Now, so FY24, of course, you've laid out the numbers, Sachin. Beyond FY24, auto industry worldwide is a very cyclical industry, right? You go through phases of slump and then you go through phases of upturn.
Yes.
Will you, to maintain 20-25% kind of growth, top line revenues, will you need to continue to win large deals year after year? Or, how do you think about that?
No, I do appreciate you asking that question. The way our business works is, you're absolutely right. And that's the point that I tried to make earlier on. Our engagements don't depend on the number of vehicles being sold. What we are working with most of the OEMs are their programs that are meant for their future to make their vehicles smarter, cleaner, and safer. And those are the investments that they must make in order to get into the new.
No, but Sachin, the point is hence you were in 100% of your revenues are autos, right?
Yes.
And when you go through a slump, the first thing which gets cut is R&D, and that's the point why we say that this spend is discretionary. So just in light of that, please continue to answer that. Yes.
I'm going to contest that a little bit. There are two types. So first, the discretionary spend is actually cutting costs from the traditional business that all the OEMs have been doing. However, this is about the future of mobility. That's where all the OEMs are investing. And this is an existential thing that all of the OEMs are working on. So these are the programs that get cut the last, I would say. That's why we feel confident about maintaining our growth in spite of the ups and downs that you may see in the automotive sector. These are the programs, usually these are 3 to 5 year programs. And once that happens, the next program for the next model year begins. Of course, there can be some cuts there, but they will not be anywhere in line with the cuts that the automakers may have to make in the other areas of their business.
All right, Sachin, different views make the market, right? But numbers will speak for themselves. So, we look forward to your numbers at some point of time. But let's focus on a couple of other aspects then. You're sitting on a cash balance of around 650 crores. You've made a couple of acquisitions. Should we be looking forward to some more inorganic growth? Point number one. And point number two, your employees, the headcount has gone up around 2,700, yes, because of inorganic growth. But do you see this number slowing down, stripped of that inorganic growth? Two-part question, use of cash as well as headcount. Go ahead.
The cash was much more before the acquisition of Technica, and this is the cash that we feel comfortable with at this point in time. That's one part. Second part, as far as the inorganic growth is concerned, the business continues to be very dynamic, and it's our sort of quest to help our clients transform their businesses. And in order to do that, we'll continue to look for anything strategic that makes sense. So we are always sensing and scanning the right kind of business for us. And if something that makes sense comes along the way, we'll be ready to make an acquisition. But there is, we'll once we have something concrete, we'll come back to you to talk about it. So that's the first question.
But a time frame, maybe? Maybe just a time frame. You did an acquisition, two in the year that closed. Can we expect another acquisition in FY24 itself? And what's the size? I mean, some ballpark idea of size, because that's intent, right? How much you're willing to put to work.
And you're also going to tell us about your headcount. So.
Yeah, I'll come to the headcount too. So I'll talk about the acquisitions. FY24, usually there is a lead time of anywhere between 6 months to 12 months. So nothing that's in the oven at this point in time that I can talk about. So it's hard for us to sort of talk about the quantum and the timelines at this point in time. But we continue to sense and scan is what I would say as far as FY24 is concerned. And if there is any kind of update, we'll be more than happy to bring you up to speed. Speaking of the headcount, yes, there was some inorganic part. However, we are also likely to have 27 to 30% growth. Our headcount doesn't necessarily grow linearly with the top line growth. However, it's we do expect the headcount to grow. I would say 20 to 25% during the course of the year. And we'll take those calls as we figure out the mix of revenues that are likely to come our way. But I think it's a fair estimate to say that the headcount will also grow in early to mid-20s.
Okay, all right. Got that. Mid-20s headcount growth. Thank you very much, Sachin. Good chatting with you as always, and all the very best for the year that lies ahead. That's KPIT Tech, a stock that has been one of the best performers in the mid-cap IT arena, continues to find traction today as well. Well, from one earnings report card to the next, Nelco put up a pretty good show for the fourth quarter as well. After witnessing a slowdown, at least in top-line growth in the last 2 quarters, revenue growth has picked up in Q4. Margins have been stable. Finance cost is slightly higher. So let's discuss some of these internals with the PJ Nath, Managing Director and Chief Executive Officer at Nelco. Mr. Nath, thank you very much for joining in. I want to start with the top line, because your revenue growth at 10.4% obviously is being well received by the street. And your guidance, if I remember correctly, is also on the higher side. You're expecting better guidance for FY24. FY23, you grew at 20-odd%. FY24, any sense of how business can shape up?
We have
I think
grown quite well. While our revenue has grown by 20% over the previous year, our services revenue has grown by 37%. And services revenue is what is more critical for a service industry like ours. And therefore, we believe that we will have a good show during FY24 as well. And I think we should have similar kind of growth that we had last year. During
So 20% plus, sir?
Yeah, we expect it will be around that.
Okay. What about margins? FY23 came in at 19%. Again, I mean, would you be in this ballpark going ahead? What's the outlook?
Yeah, it will be in that ballpark. 18 to 20% is the range that we will be coming up with.
Okay. All right. Hi, Mr. Nath. Good morning and congratulations. It's been a good year, but now things get tricky, right? As the stock price moves up, the street wants more. So let's focus on a couple of numbers. Top line growth, you're talking about close to around 20%. I recall when you joined us, you said maritime as well as in-flight communication will contribute around 30% of the total revenues. At current reckoning, what does it stand? And when you're guiding for this 20% growth, could you break it up for us, between maritime, in-flight, as well as your traditional business? What is the breakdown that you're looking at?
Yeah, so our business, we are into the enterprise business, maritime communication, as well as aircraft communication. Our aircraft and maritime communication is between 25 to 27%, and that's a kind of split that we have. We believe that it will continue on a similar range going forward as well. For the aircraft communication, it will grow maybe after 1 or maybe 2 years when the domestic market starts picking up. Till the time, the growth will be similar to what we have had so far. But the important part is that we are spread across all the 3 markets, enterprise, maritime, and aero IFC. And therefore, we have a fairly balanced spread of our revenue in the market. And we expect to see more segments opening up in the enterprise sector as well, with lowering of satellite bandwidth prices happening in the due course. We'll see more segments opening up in enterprise market as well going forward.
All right, just to confirm, sir, aerospace and maritime communication as of now is 25 to 27%, right? And the target is to take it to 30%, say in the following year.
Maybe may not be this year, but the year after that. Because what happens is that, as I said, for Aero IFC, the big jump will happen when the domestic aircraft start consuming that service, and that we believe is about 1 year away from now.
Mobile phones operating on planes. I don't know. Good for your business, but as just a consumer, I wonder if that's a good thing or a bad thing. We prefer peace and quiet for the 2 hours of that flight, right? That's on a lighter note.
Yeah, but on a same note, I may also say that we are not the ones who's going to cause the noise. We are the ones who will offer you the internet
the service.
access.
They're playing their part.
Absolutely, yes.
So you'll be doing more of Facebook and WhatsApp and all of it, and not mobile phones. So
yeah, maybe not look at office mail. Maybe watch a movie on board instead. That's one way of looking at it. Mr. Nath, as you're talking about these growth plans, I just want to get a sense of whether all of this is going to be organic or whether you are looking at snapping up any niche sort of small companies along the way, perhaps from a technology standpoint. Or will you be completely on your own as you chart this 20% plus growth in the year ahead?
We keep looking at opportunities in case there is anything interesting that we can take up. But as of today, whatever we've done is organic, and current year plan is based on organic growth. But we do keep looking around for opportunities which can happen. We also have plans of spreading beyond India, which to my mind will happen towards the later part of the year. And so we should see the revenue coming in FY25.
This in-flight sort of internet opportunity, so what is I think we have discussed this before once when you were on the program. Just to jog our memories, what is the size of the opportunity, and what will you have to do in terms of investing to be able to tap the opportunity?
We haven't really been able to put an exact number for the domestic sector as of now. And as far as the investments are concerned, that's again, a lot of work has to be done in terms of what's the business model, whether the airlines themselves will be investing on the equipment which are required to offer on the aircraft, or should it be funded by us, etc. So those details are being worked out. And as I said, this market will open up after 1 year. So those details are still going on. And therefore, at the moment, I would not like to comment specifically on that.
All right. Mr. Nath, the opportunity is very, very large, though. So let's not talk about the near term. As you're saying, the opportunity is big. So let's take a 3-year time horizon. From this 315 odd revenues that you're looking at, you're talking about maritime, you're talking about in-flight, lot of verticals. Could you tell us, where do you see the company headed, say from 3 years from now? Let's talk about FY26. What are the broad targets you're looking at? And if there is an opportunity, there's always investment as well. So what is the total investment that you'll have to make? Go ahead.
Yeah, so as I said, we don't give a guidance for the future, but going forward, I would not like to say only for the next 3 years. For the next 5 years, we see a lot more happening. Let me also tell you why. Because the satellite communication industry in India right now is focused on in a very narrow market of only enterprise, limited sectors, limited segments, maritime and aircraft communication. But with the policies opening up, with newer technologies coming up, there'll be many other sectors opening up and many other segments opening up. For example, direct-to-device could be another opportunity, which IoT, Internet of Things. We are the satellite communication not being used so far in that. So we are looking at all these growths, all these segments to open up, because of which the growth will be there'll be a leapfrogging of the growth. So that is what we are expecting. Therefore, going forward, we believe that our rate of growth will be faster than what we are doing. That's the only guidance I would like to give at the moment.
So I'm just putting in a rough number.
And just to give a perspective, as of now, as a company, we have a fairly healthy financial, good balance sheet, very low debt, good debt to equity ratio. And so therefore, whenever there is a need for investment, we don't see any challenge for us to be able to raise the funds.
Going by what you're saying, by FY26, revenues could potentially be 600 crores then. If you're going to grow at faster than 20%, mathematically, you should be there. 600 crores in the next 3 years. Possible?
Yeah, possible. Absolutely possible.
Got it. All right. Pleasure talking to you, Mr. Nath. Congratulations on a good showing. The street, though, will be looking forward to an even better showing, given that now the stock price has run up in the last few days. Look forward to chatting up with you, sir.
It's difficult to keep phones away on the ground. No reason to believe that it won't be the same challenge in the air. So it's a big opportunity.
Yeah, absolutely. Prashant, but whenever I've flown to the United States, it's nice that New York, when you fly over there, it's a good 14-15 hour flight. And I never ever had made use of any of this in-flight and all, because and I make sure I come to work on that day. So that full night, it's a 12 o'clock flight. You reach there in the next 14 hours or so. I sleep through most of it.
You're in the minority, I think. Otherwise, I heard people say, well, they've done movie marathons. So anyway, I just want to highlight two names. One is Raymond, if you can have the stock up. It's up another 5-6% after yesterday's large move, if you can have that up. And the other one is Godrej Consumer. Both, by the way, 7-8% on Raymond, and the other one is Godrej. Both have press conferences later today. I think Raymond is holding a press conference at 3:30, and then you've got a press conference at Godrej at 4:30. So one is up 8%, the other is down about 2.25% or so. Related, unrelated, we don't know. We will find out as the day goes by. By the way, LTTS is the other one I want to highlight. We, of course, had the management. The stock's up about 5% now. That's a pretty strong gain coming through. And we're seeing some follow-through moves in names like BSE, etc., Bombay Stock Exchange. It's having a, I think, good week. It's up another 4% for the week. It's up almost 15-16% or so right now. It's a big volume-led day, lots of single stocks moving around, and that's been the sort of nature of the market, at least this week so far. We'll take a break. Mitesh will be with us with some technical trading ideas on the other side.
Welcome back. Well, the market's trying to pick up some steam now, 23, 24 points high, a little better than the absolutely flat start that we began the day with. In fact, let me just look at some of the gainers. Bajaj Finance, of course, has been one of them. ITC is on the upside of the screen. There's Britannia, Nestle. There's a fair amount of consumer buying that seems to be quite evident in terms of consumer stocks today. And Reliance is the other big support for the bulls with a gain of almost 0.5%. So that's the market for now. Let's go back to Mitesh for some ideas. Mitesh, so it's trying to catch some momentum. Would you look at long trades right now? I mean, if someone has bought the dip in the morning, that's fine, but can you still buy?
Morning again, Sophie. I think we're just on the verge of breaking above this 17,850, 860 zone. So I think if somebody wants to buy now, wait for another 20 points, let the markets go beyond 17,860, then buy, keep a stop at about 17,790, 17,785. I think maybe a point below that. And, that's the trade which you can take for targets of around 79.80 to about 18.40. These are spot levels I'm talking about. And on my stock list right now, I have a buy on City Union Bank. I think some good news as well as gap up opening for the stock. I would recommend buying here with the stop at 137 for targets of 150. And Tata Power, I think, is on the verge of giving some bit of a reversal sign. So wait for the stock to get past 200, 250, that's 200.50 paisa, and then buy with a stop at about 197.5 for targets of 210.
Okay, all right. Thanks very much, Mitesh. Good speaking with you. By the way, look at KEC International. That's up 11% on large volumes. So many newer names into the mix with these large double-digit gains, and that's been the feature all day. And different names, by the way, different sectors. So it's kind of tough to identify a theme broadly because it's been so scattered all over the place. Well, Manisha is with us to talk to us about what's on her mind as far as commodities are concerned. Manisha, morning.
Morning, Prashant. I'm looking at the crude oil prices where we did see 4% decline in the overnight markets. If you look at the two trading sessions gone by, we have seen 6% of decline. And for the week now, we are down by 7% for the crude oil prices. It's trading at a two-week lows as well at just about $77 a barrel for the Brent prices. We have come down all the way from 87 on the higher side. So $10 shaved off in a matter of in the month of April itself. The declines have come in because we are looking at weaker demand concerns. So not just the crude prices, but the gasoline is trading at a 4-week lows. And you have heating oil prices also trading at the lowest since Jan 2022. The gas prices also trading nearly 60% of the kind of highs that we saw in this year itself. So sharp declines coming in across energy. It is about the U.S. slowdown fears. The consumer confidence numbers in the month of April are the lowest in 9 months. Not just that, the U.S. manufacturing data has also seen a decline in the month of March. Chinese numbers, for instance, of manufacturing also have seen a bit of a decline, and that's weighing onto the markets. And then there is EIA report suggesting that the crude inventories have fallen 5 million barrels to 460.9, but that hasn't really supported the markets because on-ground demand is still on the weaker side, and the refining is on the higher side is the reason you have seen the crude inventories decline. And then there is increase in Russia crude exports, dulling the impact of OPEC cuts. Russia, even after cutting output, is producing or exporting nearly highest since 2019. The OPEC share of Indian oil imports also is the lowest in 22 years in 2022-23 because India seems to be importing a lot of crude now from Russia at highly discounted rates. And not just India, if you look at other countries, they seem to be importing higher numbers as well. So we've seen oil loading from Russia to the tune of 2.4 million barrels per day. So Russia has increased oil supplies to India, China, Turkey, West Asia and Latin America as well. And is the reason the OPEC share has been declining there. The market have seen pressure come in because of that as well, because despite sanctions, the Russian crude oil continues to flow into the market. It is going to be about the first quarter GDP numbers coming in from US today, and then the US Fed meeting on May 3rd, 2nd and 3rd. Not just the US Fed meeting, next week you also are looking at the Bank of England and ECB, which also are expected to hike rates, and that's what's worrying the commodities. So almost all of them trading in the negative.
All right, got that. Thanks very much for the details over there. By the way, that's source-based information, and that's pretty much the big buzzing story of the day. What is this deal between Godrej Consumer and Raymond going to be like? Both companies are holding press conferences later in the day, post-market hours, and we're learning from sources that it could be a buyout. Godrej Consumer buying out Raymond's FMCG business. And you're seeing some of the categories there that Raymond is in. Men's grooming is one area that they're looking at quite closely. Stocks obviously have been very, very excited. Okay, speaking of stocks that are excited, City Union Bank has been rising away. Let's get the details going in terms of the MD's term. Abhishek, fill us in.
Well, Mr. N. Kamakodi has got a 3-year extension as MD and CEO of City Union Bank. So his term was to end on 1st of May 2023, but now he has a 3-year extension. So with this 3-year extension, he will complete 15 years at the helm of running a City Union Bank, and that is the upper limit that RBI has set in recent times. So since May 2011, he has been running as the managing director and CEO post of City Union Bank. RBI has a ceiling of either 70 years in terms of the age for MD and CEO of a bank and a whole-time director of a bank, or you have along with this 15-year time frame as the MD and CEO of the bank. So with this 3-year extension, Kamakodi will complete the 15-year duration in terms of having the post of MD and CEO of the bank. This is the limit that has been set by RBI, that is the 15 years. So recent MD tenures by RBI, if you take a look, City Union Bank, they have given a 3-year extension. For AU Small Finance Bank, Mr. Sanjay Agarwal, they have given a 3-year extension. However, for IndusInd Bank, Mr. Sumant Katpalia, they have given only a 2-year extension. Back to you.
All right, Abhishek, thanks very much for that. Ekta is now joining in to put the spotlight back on Sinjin numbers. Ekta.
Thanks for that. Well, yes, definitely a good set of numbers which have come in for Sinjin, and that is really reflected in terms of the stock performance. The revenue was up around 31% and remember that Axis estimates were around a 16% growth, so they've superseded those estimates. The margins were at a 4-quarter high, so it came in at around 31.6%, and the profit also around 178.7 crores versus estimates of around 160 odd crores. The numbers this quarter were aided by the Zoetis partnership, which was following a successful inspection by the US, EU, as well as the European, as well as the United Kingdom. Remember, Zoetis partnership is basically for an animal health drug, which is basically used to treat osteoporosis in animals. So that really came through for them. Now, in terms of revenue and profit guidance for FY23, they've done well for the entire fiscal and they've beaten revenue guidance as well. So, for example, they are up 23% on a year-on-year basis for the entire fiscal versus a guidance of around high-teen revenue growth. 29.3% in terms of margins versus guidance of margins of around 30-odd%, and up 17% in terms of profit versus a single-digit profit growth, which they had guided for. The stock, remember, has rallied quite significantly, just about trading at around over 40 times 1 year forward. As of yesterday, the stock was 4% away from its 52-week high. Today, you can see that the stock has rallied further, but still punchy in terms of valuations, but really delivered this quarter.
All right, Ekta got that. Thanks very much. That's Sinjin on the move. We'll take a break on that note. On the other side, we get chatting with Nilesh Shah from Kotak Mahindra AMC. We'll talk about this big move that we saw in Gujarat PSU stocks yesterday with the Gujarat government's new dividend and buyback policy. Coming back in just a bit.
Welcome back. We got the market, which is flat about 10 points or so right now. The index not very much happening, but so much happening across specific individual stocks like we've been reporting all week. Now, shares of all 7 listed Gujarat PSUs rallied in trade yesterday after the Gujarat state government announced a mandatory dividend distribution policy for its government sector units. The government has directed these companies to declare a minimum dividend of 30% of profit after tax or 5% of net worth, whichever is higher. The critical point is whichever is higher. We'll discuss that in greater detail. We have Nilesh Shah, Managing Director at Kotak Mahindra Asset Management Company, joining in to take some questions. Nilesh, of course, tweeted out yesterday saying, well, this is great news and other companies should emulate this as well. And Nilesh, good morning. Good to have you here. I looked at the rules which are in effect for central public sector undertakings as well. Is what the Gujarat government has done kind of bringing companies under its ambit to what CPSEs follow right now?
So essentially, Prashant, as shareholders, we want to invest in companies which allocate capital efficiently. And a clear policy on dividend distribution is a very, very welcome step. There are few private sector as well as public sector companies which have dividend distribution policy. It gives clarity to shareholders. The step taken by government of Gujarat recommending their PSUs to follow dividend distribution policy is a welcome step, as it gives clarity to minority shareholders how the company's cash will be utilized. This is something which is recommended probably for all companies to follow. It brings more clarity, improves governance.
Prashant, just as you were talking about the central government policy, I was actually looking at that notification, the 2016 notification, which I found, just for the benefit of our viewers who might be wondering the same. A CPSE needs to pay annual dividend of 30% of PAT or 30% of GOI equity, whichever is higher. Due account should be taken of cash reserves and free reserves with the CPSE. And special dividend would need to be paid to the central government, of course, in return of its equity investments. And CPSE with large cash reserves and sustainable profit may issue bonus shares. So that's the central government policy. And it seems the Gujarat government has moved pretty much in close alignment to it. Nilesh, hi, good morning. Surabhi here. I think we were discussing this with a couple of experts yesterday. And one interesting anomaly came up. In some cases, some of these Gujarat PSUs may meet the net worth criteria or may even, meet some of the other norms that have been laid out, but may not have adequate cash reserves to pay out a dividend. And there was a case, I'm forgetting which company, I think it was the case of GSPL, Gujarat State Petronet, where if you go by FY22 numbers, they'll have to take on debt, borrow to meet this dividend criteria. So I'm just wondering if this will be executed smoothly or not, and how investors need to read this.
See, essentially, this is a guideline. Each company board will take various factors into consideration while declaring their dividend. We have seen in the past even multinational company borrowing money to declare dividend. In many cases, borrowing money to declare dividend improves return on equity. But there is no one standard rule which applies to all. I'm sure the board of all these companies will take into account various factors while arriving at the dividend declaration policy.
Nilesh, would it have been better for the government to say, well, all of you need to have a dividend distribution policy. This is the date by which you need to do it. And please now formulate your own policies. What's your sense?
So this is a step in the right direction. Even private corporates have dividend distribution policies. Obviously, flexibility is built into the same. At the end of the day, the long-term value creation of a company depends upon capital allocation efficiency. In the past, we have seen derating of many giant companies when they were keeping cash reserves on balance sheet and diluting entire return on equity for the company. When this company started distributing cash, their ROEs went up and so did the valuation. Clearly, if companies have projects in which they can make investments and increase ROE of the business, by all means, they should go for, project investments. But if you are going to deploy money in debt mutual funds, in fixed deposits, in treasury, as a mutual fund manager, I like that. But purely from an equity shareholder point of view, you cannot be diluting return on equity of business by building cash reserves.
Got that. At Kotak AMC, Nilesh, I mean, would your view change? I mean, if you discuss this internally, outlook towards some of these companies, I mean, basically, I'm assuming that you fundamentally have to like companies, right? And then on top of it, if there is clarity on how dividend is distributed, that's an added plus. So what's the thought process?
Prashant.
Yeah.
Absolutely, Prashant, you hit the nail. At the end of the day, it is the business whose value is important to determine shareholder value. These are all the features which help in improving governance And if business is doing well and governance is good, then invariably you get higher valuation. We don't end up buying a stock because this policy has been announced. At the end of the day, this policy helps improve governance, which if business is doing well and market price is trading below the fair value, will result into a buy. But if market price is already above fair value, then you will wait for correction to buy into the stock.
Okay. Well, Nilesh, since we have you with us, how can we not ask you, an overall take on the market? We are going through a pretty interesting earnings season. The global picture continues to be as muddled as ever. How do you sort of tie up all the things that are at play in here? Investors are asking the same question. Will it be another flat year, or can I expect something better in the second half of 23?
So, Surbhi, clearly this is the time where there is contradictory data available. On one side, we have seen banking sector delivering super duper results, and the combined profitability of financial services, which will include PSU banks, private banks, and NBFC, is almost equivalent to what entire Nifty 50 companies earning was few years back. But this trend is not visible across every sector. Normally in the results season, first half, all the good results come out, and in the second half, all the bad results come out. So my feeling is that going forward, the results which will come are more likely to be below the expectations of the market. And more importantly, people are looking towards the future commentary. While overall economy looks reasonably decent, there is worry because of monsoon prediction. There is worry because of the consumption at the bottom end of the pyramid. So my feeling is that this is likely to be a stock picker's market. Broad indices may not move much in any direction, but if you have right stocks in portfolio, you'll be able to generate outperformance.
Okay, it's stock pickers market, and boy, I mean, absolutely the kind of wild moves we are seeing in relation to stocks. It kind of validates the point you're making. Very large moves in very quick time frames, both up and down, as we've seen all through this week. It's always a pleasure having you with us here, Nilesh. Great to speak with you. Thanks very much for your time on CNBC-TV18. 25 points lower, higher, beg your pardon, is what the Nifty is trading at, 17,837. It's a wrap from all of us here. Thank you very much for staying with us. Chartbusters is coming up next.